Hello everyone, I'm Ali, and in this lesson we'll discriminate between the different role of the preparer and the auditor and discuss the different firms that provide assurance services. You should also be able to justify the demand for audit and assurance services. It is the responsibility of those charged with governance to prepare the financial report, which include the income statement, statement of comprehensive income, statement of financial position, a statement of changes in equity, statement of cash flows, and accompanying notes. They must ensure that the financial statements are presented fairly in all material respects and are in accordance with applicable financial reporting framework. Also, they need to assure the users of those financial reports that there are internal controls that are designed and operated and are operating as intended to ensure the integrity of the financial report. They are also responsible for maintaining records and documentation relating to financial report preparation. They also need to make sure that the audit team has access to all information such as company's accounting records and documentation. An auditor has unrestricted access to staff within the firm from whom the auditor determines it is necessary to obtain evidence relevant to the engagement. It is the responsibility of those charged with governance to ensure that information contained in the financial report is relevant, reliable, comparable, understandable, true, and fair. Any information is considered relevant if it is useful in assisting financial report users to make and evaluate decisions about the allocation of scarce resources. Users are normally interested in evaluating past decisions made by the management and predicting whether the entity will remain viable into the future. For example, the users can use current information to estimate future price movements, likely dividend payments, and the ability of the entity to meet its immediate obligations. The next concept is reliability. The information included in the financial report should be reliable to the users of that report. Any information is considered reliable when it is free from material misstatements. The information contained in the report should be comparable through time. Users should be able to trace an entity's performance to identify any trends that may influence their perception of how well the entity is doing. This means information in financial report must be presented consistently across time and across entities. The information included in the financial report should be understandable. Users need to understand the information presented in the financial report in order to make appropriate decisions. Therefore, notes to the financial report need to be used by the preparers to provide additional details to help in the interpretation of the accounting information provided. The information included in the financial report should be true and fair. Truth and fairness or presented fairly refers to the consistent application or faithful application of accounting standards or an applicable framework in Australia, which is AAS, Australian Accounting Standards, and the Corporation Act 2001 when preparing the financial report. It is responsibility of the auditor to form an opinion on the truth and fairness of the financial report. In doing so, the auditor will assess the accounting policy selected for the client. Specifically, the auditor will evaluate whether those accounting policies are consistent with the financial reporting framework used by the entity. The auditor will also consider the accounting estimates made by those charged with governance and management to determine whether the estimates are reasonable. The auditor will assess the relevance, reliability, comparability, and understandability of the information presented in the financial report. It is recommended that when undertaking an audit, the auditor should use professional skepticism, professional judgment, and due care. Professional skepticism refers to the attitude adopted by the auditor when conducting the audit. This means the auditor should remain independent of the entity, its management, and its staff when completing the audit work. Also, auditor should maintain a questioning mind and thoroughly investigate all evidence presented by their client. The auditor must seek independent evidence to corroborate information provided by their client. Auditor must be suspicious when evidence contradicts documents held by their client or inquiries made of client staff. It is important that the auditor search for evidence that challenges and not just confirms management's assumptions. Next is professional judgment, and it relates to the level of expertise, knowledge, and training that an auditor uses while conducting the audit. An auditor must utilize their judgment throughout the audit. For example, an auditor must determine the reliability of an information source and decide on the sufficiency and appropriateness of evidence gathered. The procedures to be used in testing and an appropriate sample size. Due care refers to being diligent while conducting an audit, applying technical and statute-backed standards, and documenting each stage in the audit process. Assurance services are provided by accounting and consulting firms. There are 3 tiers of assurance providers in Australia. The first tier comprises the largest accounting firms in Australia and are known collectively as the Big Four. The firms that comprise the Big Four are Deloitte, EY, KPMG, and PwC. These 4 firms operate internationally and dominate the assurance market throughout the world. The next tier of accounting firm is known as mid-tier or second tier. The firms that comprise the mid-tier have a significant presence nationally, and most have now international affiliations as well. The firms that make up the mid-tier in Australia include BDO, PKF Australia, Grant Thornton, Pitcher Partners, Morris Stephens, NextGen, RSM, Baird Cameron. These firms serve medium-sized and smaller clients. The next tier is made up of regional and local accounting firms. These firms service clients in their local areas and range in size from single partner firms to several partner firms. All of these accounting firms provide audit as well as non-audit services. Non-audit services are any professional services provided by an auditor which are not connected to an audit or review of an institution's financial statements during the period of an audit engagement. The non-audit services include management consulting, mergers and acquisitions, insolvency, tax and accounting services. In Australia, the director's report of a listed company must include a section headed non-audit services. That section must include these points: the details of the amount paid or payable to the company's audit for non-audit services. Each non-audit service must be listed separately along with the amount paid or payable for that service. A statement of whether the directors are satisfied with the provision are satisfied that the provision of non-audit services by the auditor does not affect the auditor's independence, and if the directors are satisfied that auditor independence has not been impacted by the provision of non-audit services, a statement of the director's reasons for being satisfied need to be included. In this section, you will learn about key financial report users and their requirements and why these users may demand for an audit of the financial report. There are several users of financial report, and each user will read the financial report for a slightly different reason. The first is investors. Investors generally read the financial report of a company to determine whether they should invest in or buy, hold, or sell shares in that company. They are interested in the return on their investment or their ROI, and are concerned that the entity will remain as a going concern into the foreseeable future. They may also be interested in the capacity of the entity to pay a dividend. The next is suppliers. Suppliers may read a financial report to determine whether the entity can pay them for goods supplied. They're also interested in whether the entity is likely to remain a going concern and continue to be able to pay its debts when pay its debts when they fall due. Consumers may read a financial report to determine whether the entity is likely to remain a going concern if the customers relies on the entity for their business. Lenders may read a financial report to conclude that whether the entity can pay the interest and principals on their loans and when they fall due. Employees may read a financial report to determine whether the entity can pay their wages and other entitlements such as long service leave. They may also be interested in assessing the future stability and profitability of the entity, as this affects their job security. Government may also read financial report to determine whether the entity is complying with regulations, is paying a fair amount of taxation given its reported earnings, and to gain a better understanding of the entity's objectives. The general public may read a financial report to determine whether they should associate with the entity, for example, as a future customer, employee, or supplier, and also to gain a better understanding of the entity, what it does, and its plan for the future. There are a number of reasons why some or all of the financial report users, which I just discussed in the previous slides, would demand for an audit of the financial report. The first is remoteness. Most financial report users do not have access to the entity under review. This makes it difficult to determine whether the information contained in the report is a fair presentation of the entity and its activities for the relevant period. Therefore, financial report users would demand an audit of a financial report. Complexity is the second one. It is normal that most of the financial report users do not have the accounting and legal knowledge, so it becomes difficult for them to assess the reasonableness of the complex accounting and disclosure choices being made by the entity. Competing incentives. Management has an incentive to disclose the information in the financial report in a way that presents their performance in the best possible light or helps them achieving their own objectives. Users may find it difficult to identify when management is presenting biased information. Reliability. Financial report users make decisions on the basis of the information contained in the financial report. Therefore, they are concerned about the reliability of the information contained in the financial report. As a result, they would demand an audit of a financial report. An independent review of the information contained in the financial report by a team of auditors who have the knowledge and expertise to assess the truth and fairness of the information presented by the preparers help users across all of these issues. Auditors have access to entity records, so they're not remote. They are trained accountants and so have detailed knowledge about the complex technical accounting and disclosure issues required to assess the choices made by the financial report preparer. Independent auditors have no incentives to to help the entity in presenting its results in the best possible light. They are concerned with ensuring that the information contained in the financial report is reliable and free from any significant misstatements. In this section, we'll look at the 3 theoretical frameworks that will help you in understanding why there is demand for audit. Agency theory. In a business, when an individual is owner as well as the manager, then there are no competing incentives because the owner or the principal and manager, who's the agent, are the same person. However, in case of a large listed firm, when there are several owners, it is not possible for each owner to participate in the operational activities. Therefore, the owners hire a manager to run the business on their behalf. Then potential conflicts arise because the managers do not necessarily have the same incentives as the owners of the company. Agency theory is based on the assumption that each party will act in his or her self-interest. Managers are engaged to run the company on behalf of the owners, but will probably be trying to maximize their own resource consumption. Therefore, agency theory tells us that due to the competing incentives between the managers and the owners and remoteness of the owners from the entity, the owners have an incentive to hire an auditor to assess the truth and fairness of the information contained in the financial report prepared by the managers. Managers also have an incentive to hire an auditor to demonstrate to their shareholders that they have prepared true and fair financial report free from fraud and error. Information hypothesis. The users of financial report requires access to high quality information to make a variety of decisions. They use the information provided in the financial report to determine whether to hold or sell shares in the entity or whether to lend money to the entity and what rate of interest to charge the entity on money lent. The greater the perceived quality of the information contained in the financial report, the more likely it is relied upon by the users of that information. Thus, the information hypothesis tells us that due to the demand for reliable, high-quality information, various users, groups including banks, shareholders, will demand that information reports be audited and help their decision making. Insurance hypothesis. Investors take on a risk when buying shares. If the company fails, investors could lose the money they invested. According to the insurance hypothesis, an audit is one way for investors to insure against at least part of their loss should the company they invest in fail. Auditors are required to take out professional indemnity insurance policies in Australia. Therefore, they're seen as having deep pockets. If investors are able to prove in the court that the audit negligence was behind at least in part of their loss, then they may be able to recover some of the money or losses from the payout of those insurance policies. The insurance hypothesis tells us that investors will demand that financial reports be audited as a way of ensuring against some of their losses. In the next video, we'll look at different regulators and regulations surrounding the assurance process in Australia.